Okay, good evening. This is Professor Mayer. This is our 7th chat session. What we're going to do is we're going to go through a couple of problems related to accounting changes, correction of an error, regroup in terms of some additional comments related to our Chapter 22 related to accounting changes, errors, and then move directly into our discussion specifically related to the cash flow statement of cash flow. Statement of cash flow is we will probably end up spending about a half hour tonight, and we want to have sort of an overview in terms of understanding some specific components of this. And then what we're going to do is to have our second discussion next class, which is going to be 2 weeks from today. So let's talk about the first question and see what we've got here. So the first question is, this is a change in principle, long-term contract. What we're looking at here is we have Cherokee Construction Company began operations in 2011 and changed from a completed contract method to the percent of completion method for accounting for long-term contracts during 2012. For tax purposes, the company employs the completed contract method and will continue to do so in the future. And essentially what this means is that we're going to create a deferred tax liability related to the reported income that is not taxable. So what we have is in 2012, we are using the percent of completion method. So we are reporting our pre-tax income of $700,000. But the issue becomes is what are we going to do in relationship to 2011? So if we assume the tax rate is 35%, is what is the amount of net income that would be reported in 2012? And the answer is that we're using the percent of completion method. This is $700,000. Our income tax rate is 35%. So our net income is $455,000. We are going retrospectively. Retrospectively is we are going back, and essentially what we need to do is we need to adjust the reported financial statements for 2011 with the adjustment. So we're going to do this by creating this construction in process account. We create the deferred liabilities. This deferred liabilities is the difference, so that's $170,000 times 35%, and then retained earnings is we are bringing our last year number to the point where it is a percent of completion contract, but because it's last year, what's happening is it's being reported as a adjustment to retained earnings. So again, let me just go back here and make sure that we understand this. So we're looking here at this $170,000 number for 2011, and the reason that becomes important is because this then creates the environment where we are now moving everything. So we have that comparability from last year to this year for this construction in process account and our income. And the assumption here is, if you're looking at this, is we did the change in 2012, and we're assuming that there are no contracts that are actually extend beyond a complete year. In other words, there's nothing that started in 2011, or excuse me, 2010 and finished in 2012. So the long-term contracts are only within a 2-year period and not a 3-year period. Hence, we don't have to do any adjustments for 2011, but what we're doing here is we're doing the adjustment to the beginning balance of retained earnings for 2012 for that adjustment that we see in 2011. What we see here is we have accounting change. So we're looking at depreciation. Depreciation is we're only moving forward, we're not moving back. So what we have here is we have Royal Billiard acquired the following assets: equipment, estimated life 5 years, salvage value $15,000. We acquired this for $465,000, and we have a building estimated service life 30 years with no salvage value. That is $780,000. The equipment had been depreciated using sum of the year method for the first 3 years for financial reporting purposes. In 2012, the company decided to change the method of computing depreciation to straight line for its equipment, but no change was made to the estimated service life or the salvage value. It was also decided to change the total estimated service life of the building from 30 years to 40 years with no change in the estimated salvage value. The building is depreciated using straight line. What we're looking at here, in the sum of the year, 2009, 5 divided by 15 times $450,000. 2010, 4 divided by 15 times $450,000. You get the idea of sum of the year. So what we've depreciated up to this point is $360,000. We then determine the net book value, the cost minus the accumulated depreciation of $360,000, and we have $105,000. Salvage value is $15,000. Our new book value is $105,000, and our depreciation is going to be the next 2 years, $90,000 divided by $45,000 a year. So for the next 2 years, the depreciation is $45,000 per year. We are not going back and doing any adjustments for depreciation. We're only going forward. And in this case, we identify the new book value, cost minus accumulated depreciation, identify what changes we're going to do in relationship to our depreciation method, the useful life, the salvage value, and then recalculate our depreciation, and going forward that then becomes the amount. Now, related in relationship to the building, what we have is we have a straight line depreciation. So the straight line depreciation is we've had it for 3 years. So we have $78,000 of depreciation. So the book value as of December 31st, 2011 is $702,000. We have decided that the building has a useful life of 40 years, but 3 years have already expired, so it's 37 years. So $702,000 divided by 37 years gives us $18,973. Hence, going forward, and again, we're not going back, but going forward, our depreciation is $18,973, and accumulated depreciation the same amount. Okay, so depreciation, we only go forward. Certain things we go back, but depreciation, we only go forward. In this case, we have two things. We have a change in estimate and an error. So what we see here is we have presented below the comparative income statements for Pennebecker for 2011 and 2012. So what we see is we have net income, $52,000 in 2012, $78,000 in 2011. The following additional information is provided. In 2012, Pennebecker decided to switch its depreciation method from sum of the year to straight line. The assets were purchased beginning of 2011 for $90,000 with an estimated useful life of 4 years and no salvage value. The income statement contains depreciation expense on the asset at the beginning of the year in 2011. And then the second point is in 2012, the company discovered its ending inventory for 2011 was overstated by $20,000. The ending inventory for 2012 is correct. So we want to prepare the adjustments. And the adjustments are going forward. So essentially the first thing is we have a new book value for the assets. We simply move forward for the next 3 years at $18,000. So the cost was $90,000, depreciation of $36,000 in up to 2011. So the new book value is $54,000. We have 3 years remaining. 54 divided by 3 is $18,000 per year. So 2012, our depreciation expense is $18,000. What we see here is that we have a correction of an error. The error occurred in 2011, so this is where the correction occurs, $20,000. 2011, the cost of sales increased by $20,000. The cost of sales decreased in 2012. The cost of sales decreased by $20,000. As a result, net income for 2011 is overstated by $20,000. Net income for 2012 is understated by $20,000 as a result of the inventory error. So let's kind of think about this. So what we're saying, if the inventory was too high, it means that we reported as our cost of sales too little. What we have here, so our cost of sales increased in 2011. Now the cost of sales decreased in 2012. And what we see here is that the understatement is sort of changed between 2011 and 2012. Depreciation expense for 2012 we see here. So what we see here at the bottom, an acceptable presentation for 2012 is retained earnings as reported, prior period adjustment of $20,000, retained earnings as adjusted, net income less dividends, and we have our retained earnings as of December 31st, $156,000. Inventory is one of those things that is self-correcting, but when the error is identified, we need to understand that we need to adjust basically two errors because the inventory is going to affect the cost of sales. So let's go through a couple of these questions and then we'll move directly into our next chapter related to the statement of cash flow. Listed below are various types of accounting changes and errors. And basically what we're looking for is, are we going back, are we going retrospective, or are we going forward, or going prospective? Prospectively, are we going forward? Are we going retrospectively? Are we going back as well as going forward? And then C is neither of the above. So let's go through this. So a change from FIFO to average cost in the inventory method is we are accounting for this retrospectively. So a change in principle, so it's just FIFO to average cost, we are changing retrospectively, meaning that we are adjusting our prior period financial statements to reflect the change. And then we're going to explain this change in the notes to the financial statements. Now what we're looking at is a change due to an overstatement of inventory. So the last example that we had is 2011 inventory was overstated. At the end of 2012, the inventory was acceptable. So between 2011 and 2012, the issue was self-correcting. However, we are retrospectively restating our financial statements for 2011 and using the new numbers as part of our presentation of multi-year statements in our financial statement. Change of sum of the year to straight line method depreciation. Depreciation basically is very similar to a change in estimate, and we are going prospectively. So we are looking forward related to this as opposed to going back and changing any depreciation. Changes from presenting unconsolidated to consolidated financial statements. We have to do this retrospectively. So for comparability purposes, just kind of visualize this. If you have 2011 and 2012 financial statements presented, 2011 statements, you have not acquired any company. 2012, you have a company that you acquired that is 3 times as big as you are now. At least in a pro forma format, what the prior year financial statements look like is it's going to look like there was some sort of growth taking place that was directly attributed to the merger, but you would not understand that without retrospectively restating these numbers. Changing from LIFO to FIFO, we would look at this retrospectively. Changes in the rate used to compute warranty costs, prospectively, we're only going forward. We're not restating any of our prior numbers. Changes from an unacceptable accounting principle to an acceptable accounting principle is we are retrospectively making the change. Changes in the patent amortization period, we are doing this prospectively. Change from completed contract to percent of completion, retrospectively, we actually had an example of this. Changes in plant asset salvage value, prospectively, we're going forward. This actually is the piece that we want to cover related to our changes in estimates. And we're going to have plenty of time to go through our next slides. And the next slides is where we are now introducing the statement of cash flow. We'll provide an overview of the statement of cash flow tonight. I always like to start off with the statement of cash flow from the perspective that one of the things that I find very fascinating related to accounting. We spend the whole semester talking about the virtues of accrual-based accounting. And there certainly are significant virtues related to accrual-based accounting. It really is defining where we are in terms of answering the question, how much do we make? But the problem with accrual-based accounting is it ignores, for the most part, the most important aspect of a business, and the most important aspect of a business is to be able to generate and manage cash. So from a decision-making perspective, the statement of cash flow is extremely important. Now what we have here is what we're talking about is we're able to understand the organization from the perspective of the accumulation and the use of cash. So we're understanding cash coming from operations. So if the company is making widgets, as an example, we want to be able to isolate how much cash we are generating as compared to how much cash we are spending in terms of manufacturing and selling widgets. We're also interested in how much cash we're using for capital projects, as well as understanding the cash coming in and going out related to equity for acquiring stock, buying back treasury stock, as well as paying dividends. So we have this very interesting structure within the statement of cash flow where we're able to understand what truly is taking place related to this. Okay, and what's taking place is that what we have is we have three elements of the statement of cash flow. We have cash flow from operations, and essentially cash flow from operations answers that question is how much cash are we generating from our primary business. So again, if we're making manufacturing and selling widgets, how much cash are we generating from that activity? Then we have investing activities, the sale of property, plant and equipment, the sale of investments in securities, as well as the cash outflow, the purchase of property, plant and equipment, intangible assets, purchase of investment securities. One of the fascinating things related to the operating cash flow and the investing cash flow is if you visualize the fact that operating cash essentially is explaining what we're doing in terms of generating cash on a day-to-day basis. Our investing activity is how we're spending cash that is basically planning for the future. And the idea is in the statement of cash flow, what we're truly trying to understand is this interplay between current activity and future activity. And in fact, there is this term that's used in finance, and the term is called free cash flow. And free cash flow is looking at operating cash, and then we subtract from this the cash outflow coming from our investing activities. The idea is that if a company is truly planning for the future, they're spending money for the future. And this is going to show up as a negative cash flow from investing. But if we take our operating cash, we subtract our cash outflow from investing, and we also would take out or subtract our preferred stock dividends, because this sort of really relates to the cost of capital as we were considering the organization. But we take this formula, operating cash minus cash outflow from investing minus preferred dividends. And what that gives us is what we call a free cash flow. If that number is positive, that's a good thing. That essentially is a sign that the organization is planning for the future, and they're actually able to pay for this future growth with current activity cash and actually have money left over. So the idea is this is, in essence, creating wealth for the organization. And in fact, it's a very good thing. Frankly, it's one of the reasons that when you look at an organization, one of the first things you want to do is to take a look at the statement of cash flow. Cash is very, very important, and understanding that becomes extremely important related to the organization. We talk about financing activity, issuance of stock, issuance of bonds and notes. These are stocks and long-term debt, and this would be cash inflows. Cash outflows for financing activities, payment of a cash dividend, the repurchase of stock, the repayment of debt. These would be the items that we would consider a cash outflow from financing. What we see here is we see a standard statement of cash flow. If you're looking at this, the first thing you should notice is the fact that this is using the direct method for calculating cash. So we're looking at cash flow from operations, cash inflow from customers, from investment revenue, cash outflow for activities such as suppliers, employees, interest, insurance, and taxes. So we have a net cash flow from our operating activities of $22. Cash flow from investing activities, you notice how this is a negative number, and the negative number from investing really does imply that the organization is purchasing things for future growth. And then cash flow from financing, sale of common shares, repayment of bonds, payment of cash dividends. Doesn't really distinguish whether or not these are common stock or preferred stock cash dividends. But the one thing that you do notice is that the cash flow from operations is actually greater than the cash outflow from investing. And again, depending upon what the preferred stock dividends are, this actually is a very good sign and really is reflective of the fact that the organization is growing because they truly are investing in the future, which is great. What we're doing here is we are reconciling our income to cash flow from operations. And what we're looking at here is we're looking at the indirect method, and we're actually going to spend a lot of time on this, but what you notice, and we talk specifically related to the net income, to the statement of to cash flow from operating activities, is we start off with net income, and then we do specific adjustments related to this net income. The other point that we want to make here is that there are non-cash investing and financing activities. So the idea is that if something goes to the statement of cash flow, is because we actually have the cash or actually paid out the cash. Now, that doesn't always happen. So as an example, if you get a mortgage for a house, in that transaction, the money from the bank doesn't go to you and then you pay the owner of the house. Is the money goes from the bank to the owner of the house. So it's bypassing you. So this is what we would consider to be a non-cash investing activity. And essentially we acquired equipment by issuing the note. So the note was directly tagged to the equipment and was actually paid from the bank and went directly to the owners of the equipment. So it bypassed us. So this would be considered a non-cash transaction and something that we report on but it's not going to be a part of the investing activities within the financial statement. The importance of cash flow primary is that companies must closely monitor their cash to stay in business. I think that's pretty important. This whole idea of cash is king is extremely important, and especially when things are not going well in the organization, whether economic or other activities, it's very important that we actually have cash. Cash can sustain an organization during an economic downturn, but if we don't have the cash and we face some sort of economic downturn, it can be extremely detrimental to our future growth. Okay, so the first thing that we want to talk about is what is cash. And the idea is that cash is cash and also short-term, highly liquid investments that are readily convertible to cash with little or no risk to the organization. So we don't differentiate in the statement of cash flow between cash and cash equivalent investments. Companies must establish this policy which regards to what is the classification between these short-term highly liquid investments and other investments that we would not be reporting as cash and cash equivalent. Note to a financial statement, I won't read this, but basically what this describes is the policy related to the cash and cash equivalent. And basically what we're saying here is, or what Exxon is saying, is that highly liquid investments with maturities of 3 months or less when acquired are classified as cash equivalent. So the idea is that it is a maturity of 3 months or less, and the idea is that's the maturity at the inception of the instrument. So we're not talking about a 12-month instrument that we're within 3 months of maturity. We're talking about the investment itself that has a total maturity of 3 months or less. Primary elements: operating activities, investing activities, financing activities. We are reconciling the net increase and decrease in cash, and we are also identifying the non-cash activities. What we're looking at here is we are comparing the cash coming from the income statement and relating it to our cash flow from operation. So revenue is going to come from sales as well as investment income. This is going to be our cash inflows, cash received from customers, cash revenue received, dividends, interest. You notice that if the income statement includes gains and losses on the sale of the asset, this is not reported on the operating activity. This is actually reported in the investment activity. So when we are looking at the income statement, and especially we're going to see this when we do the indirect method, is we are adjusting out the gains and losses to the sale of equipment or the sale of assets, because the sale of the asset is not an operating activity but is in fact an investing activity. The expenses, cost of goods sold, salary expenses, these are all cash outflows. And again, we're looking at two categories: cash paid to suppliers and cash paid to employees. Interest expense is going to be a cash paid to creditor. Other operating activities, cash paid to insurance companies and others. Income tax, cash paid to the government. And hence we have the net cash flow from operating activities. And this is basically what we're describing as the direct method. So in the direct method, cash flow from operating activities are the element of the net income, but what we're doing is we're reporting this on a cash basis. So cash inflows from customers, investment revenue, and cash outflows to suppliers, to employees, for interest, for insurance, for income tax, and we have our net operating activity cash flow. So you notice cash inflows are positive numbers, the cash outflows are negative numbers. One of the more interesting ways as we consider the statement of cash flow is when we look at the indirect method. So in the indirect method, what we're doing is we are starting with our net income, and then what we're doing is we are making adjustments from the net income. So we have adjustment for non-cash effects. Okay, so the first thing is you notice that we adjust out the gain on the sale of the land. And why are we doing this? Well, the purchase and sale of capital equipment is reflected in the investment activities and is not reported on the operating activities. So we adjust these out. So the gain is a negative adjustment. You notice here the loss on the sale of the equipment is a positive adjustment because basically a loss lowers net income, but it has no tax effect, or excuse me, has no cash effect as it relates to operating activities. And then the next one is the depreciation expense. So what is depreciation? Well, depreciation is the allocation of the consumption of a fixed asset. Well, when we purchased that fixed asset, that was a negative cash flow item in the investing activity. However, this adjustment where we are creating this depreciation expense to reflect the consumption of the asset, it lowers net income, but it is not a cash item. Depreciation shows no cash. The depreciation expense is the debit. The credit is not cash. No, the credit is accumulated depreciation. So what we're doing with depreciation is we are adding this back to the net income from operating activities. Now what we're looking at is we generally look at the current assets and current liabilities as they relate to the income statement. Most of them do, and usually in the problems that you see, you'll see the statement that all current and current assets and liabilities are impacting the income statement. You notice here is we are making adjustments, and I want you to really focus on the fact that the adjustments are different as compared to whether they are current assets and current liabilities. And I'll make a point here, is you notice that we have an increase in accounts receivable, which is a negative adjustment, and we have an increase in accounts payable, which is a positive adjustment. When you take the CPA exam, I'll give you a very, very easy hint to think about this, is if you are adjusting the change in current assets, the adjustment is opposite the change. So in this case, accounts receivable increased. Let's say it increased from $98 to $100. Well, that increase is reflected in a negative adjustment. And when you kind of think about this, basically an increase in accounts receivable represents a sale that does not have any cash inflow, because the sale is, just kind of visualize this, if this was the only transaction, you have accounts receivable that's a debit, sales is a credit, sales increases, therefore net income increases. However, there is no cash inflow from that specific transaction. So the adjustment is negative. Now look at the accounts payable. So now the current liabilities is the adjustment is the same direction as the change. Let's kind of think about this, is what is accounts payable? Accounts payable is where we are buying resources from our vendors that essentially relate to cost of goods sold. Cost of goods sold increases our expenses, decreases net income. But we're assuming that we pay for them. And the idea is that if we increase accounts payable, this reflects a resource that we have paid for that becomes an expense. But this resource does not, as of yet, have a cash outflow. Therefore, the increase in accounts payable is going to increase the adjustment. That's a positive adjustment. So basically it increases the net cash flow from operations as we were making the adjustments from net income. Now, think about that as you go through these transactions, and I guarantee you that there will be one or two questions that if you understand the direction of the change and the direction of the adjustment, it's a very easy solution as you're looking at these problems when you're working through the CPA exam. Cash flow from investing, we've talked about this, is the inflow and outflow based upon the acquisition and the disposition of assets. And basically what we're saying here is that as we buy assets, this is a cash outflow from investing. If we sell assets, it's a cash inflow, and we're reporting it as an investing activity. Which, by the way, just keep in mind that the cash flow from operations is the only segment within the statement of cash flow that we can use the indirect method. Everything else we're using the direct method, and we're looking at cash inflow, and we're looking at cash outflow. So the things that we're looking at is property, plant, and equipment, investment securities, except for cash equivalent and trading securities, and non-trade receivables. When these assets are liquidated, any cash receipts from the disposition are also classified as investing activities, which is why the gains and losses are excluded from the cash flow from operations because they're gains, but the idea is that if there's any cash inflow or outflow related to this transaction, it's going to be reported in the investment activities. So we certainly would not report it in the investment activities and also report it in the operating activities, but any gains and losses, again, excluded from operations and moved over directly to the cash flow from investing. Cash flow from investing, what we're looking at here is purchase of land. So we purchased it, and this is a negative cash outflow, $30. Purchase of short-term investment, we purchased it, it's a cash outflow. Sale of land, we acquired land. Sale of equipment, we acquired equipment. And again, we acquired this equipment for cash. So want to make this distinction between the cash that we are using for investment activities as compared to the non-cash transaction where we are using debt to acquire this, but the cash from the debt doesn't pass through us. It goes directly to the seller of the equipment that we're buying. Cash flow from financing, cash inflows and outflows result from external financing of the business. So we're talking about common stock, preferred stock, the issuance of the bond, and other debt securities. Cash outflows relate to the buyback of stock, repayment of debt, and the payment of cash dividends to shareholders. Stock dividends, obviously, there is no cash outlay for that, so that is something that we would not consider as a financing activity, and in fact is a sort of one of those little minor points that you want to think about, because you're going to see problems and you're kind of going through this and you see dividends and you start deducting that. Make sure you understand when you see that problem in the CPA exam, it may say dividends, but make sure you understand that you need to read the word before that, whether it says a stock dividend or a cash dividend. Because again, stock dividends are not going to show up on the cash flow from financing activity because it is a non-cash transaction. What we see here is we sell of common shares for $26, the retirement of a bond payable of $15, the payment of cash dividends $5. So what we have is a net cash flow from financing of $6. As a company matures, what you generally see is at the beginning you're going to have a positive cash flow from financing because you are issuing stock, you're acquiring debt. As the organization matures, you're probably buying back some of these securities as treasury stock, you are retiring the bond payable, and then as the company matures is you're paying cash dividends. So as the company matures, you generally start to see a net cash outflow from financing within the organization. We'll do a couple of questions here. So what we see here is selected information from this company in Bragulello Corporation. I'm not sure where they get these names from. Accounting records for the financial statements are as follows. What we see here is cash paid to acquire equipment, $20. Treasury stock purchased from cash, $22. Proceeds from the sale of land and building, $45. Gain from the land and building, $16. Investment revenue received, $33. And cash paid to acquire equipment, $40. On its statement of cash flow, should report net cash flow from investing activities as follows. So let's look at investing activities. So investing activities is what we have proceeds from the sale of the land. There's a gain from the sale of the land, and we have the cash paid to acquire office equipment. So we have a couple of items here. So let's look at the answer. So we have two items here that we want to focus on. Is the proceed from the sale of the land is $45. The cash paid to acquire equipment is $40 that you see here. And then cash paid to acquire the equipment is $20 up here. So we have these three items here. We have cash to acquire equipment. We have the proceeds from the sale of the building. And then we have cash paid to acquire the equipment. Okay. So you notice one item is excluded from this transaction, and that is the gain. So the gain is excluded. Just kind of make sure that we understand why is the gain excluded. Well, the gain is basically cost, accumulated cost as compared to the selling price. That is an income statement item. We exclude the income statement item related to gains, but what we're reporting on the investment activity are the cash proceeds, the cash in and out, and we're not considering the cost of the equipment in the specific transaction. Selected information from Central Corporation accounting records and financial statements for 2016 are as follows. And just to be specific, what we're looking for is we're looking for financing activities. Okay, so let's look at a couple of these financing activities. We have cash paid to retire bonds. That's a financing activity. That is a cash outflow. We have treasury stock purchased for cash. That is a cash outflow from investing. Proceeds from the investment of common stock. This is a cash inflow. Proceeds from the issuance of mortgage bonds, $80. Cash dividend paid to common stockholders. Cash interest paid to bondholders. Now you notice there's a distinction between dividends and interest. The interest is going to be an income statement item. The dividends are going to be paid through the investing activities. So let's look at this and back into the answer. So the answer is $45,000. And let's look at each of these elements and make sure that we understand. So what we have is proceeds from the issuance of stock. That is a positive cash flow item. Proceeds from the mortgage bonds, which is $80. The cash outflow is cash paid to retire the bonds of $30. That's a cash outflow. Treasury stock purchased for cash, $50. That's a cash outflow. And then the cash dividends paid is the $25. That is a cash outflow. So again, the only thing here that is not specifically related to investing activity is the interest. And why is this? Well, the interest is a part of the income statement and hence is going to be an operating activity. Let's go through one more problem very quickly and then we'll call it a night. So what we're looking at here is reconciliation with changes in cash. So what we're looking at here, we want to make sure that we understand that the numbers that we come up with in terms of our total cash flow from operating, investing, and financing should in fact be the same as the change in cash balances from December 31st as compared to January 1st. So the idea is that we have this reconciliation. Reconciliation is we take January 1st, we subtract January 1st from December 31st. This relates to a net increase or decrease in cash, and this amount should relate to the sum of operating cash plus the sum of the investing cash plus the sum of the financing cash. Non-cash investing, that we've talked about this, is that when we have a transaction where there are non-cash transactions, and what we mean by this is we acquire debt, but this debt goes directly to the seller of the equipment, so that the cash from the debt doesn't pass through us, but it goes directly to the seller, that this would be considered a non-cash investing and financing activity, and we report it separately, and this is not going to be in the statement of cash flow in any of the elements, either investing, financing. Of course, it would not also be in the operating activities. Okay, so I think we covered the basic elements specifically related to the statement of cash flow, and what we're going to do in our next session is we'll spend the whole time going through very specific problems. So I thank you very much for your time. I certainly appreciate it, and we will have this discussion again in 2 weeks. Okay, thank you very much. Have a good night.